How's it going, everyone? My name is Amos, and it's about that time. It's time for another portfolio roast session. And by the way, if you're ever wondering, are these fake, hypothetical? No, these are very real. They're portfolios that have been submitted by viewers like you. Now, if you like what you see and you want to give it a go, there's a Google form link in the pinned comment and video description, and all the details and goodies are included in that Google form. Today, we're going to be taking a look at Adam's portfolio. Now, Adam is 31 years old, and during the weekdays, he drives for Uber full time. I'm talking about from 7 a.m. all the way to 10 p.m., and he's pretty flexible on his lunch breaks. Sometimes it's like 15 minutes, sometimes it's for like 3 hours, depending on whether or not his favorite sports teams are playing that day. And on the weekends, he does a little bartending. He pretty much works 7 days a week. He does not take time off. But you know what? He's 31, so I feel like, it's not the worst thing in the world, but he should be a little cautious of working so freaking much. And when he's not driving drunk people around town, he studies the stock market and he hunts for the next big compounder. And in true Warren Buffett fashion, even though he makes quite a lot of money, he still drives a 2006 Toyota Corolla. And by the way, a situation update, I had the flu for about a week and a half. Dude, it was rough. I'm feeling much, much better. And last night, I actually did my first workout in 2 weeks. So my entire body is so sore. I'm talking about places that shouldn't even be sore, like the nipples, bro. I only did a few push-ups and a few pull-ups, and I'm like, dang, I'm so sore. Dom's is, it's kicking in pretty hard. But anyways, we'll be treating Adam's portfolio as if it's an MBA case study. We'll be looking at the good, the bad, and the ugly. And just keep in mind, please, that none of this is financial advice. Don't you dare think it is. It's just for fun. If that sounds good with you, let's go ahead and get into it. All right, what you see on your screen right now is Adam's portfolio. He has 18 different holdings, and the goal of the portfolio is really simple: to maximize growth and total return. And the strategy, how is he achieving this? By buying profitable growth stocks and dollar cost averaging into his 401k mutual funds, like whatever your employer's total market ETF or mutual fund is. And his current situation, it's $430,000. Now, depending on the day, it fluctuates. Sometimes it's like 425, sometimes it goes as high as 440,000, but just shy of $500,000. He drives for Uber, friends and family. Pretty wild, right? And if you look at the breakdown and composition of his portfolio, about 56% are in those index funds and mutual funds, and the other 43.5% are allocated towards the individual stocks. And at this given moment, Adam is not really into dividends. But having said that, Adam does not mind them. It's kind of like when a restaurant, if you go to a Korean restaurant, they're really big on service. If they give you free dessert, you're gonna take it, right? Even if your wife nags at you and says your belly is getting a little round, nobody's gonna say no to a free dessert. So he doesn't care about dividends, but if it does pour in, And what are my high-level thoughts and opinions on Adam's portfolio before we dive a little deeper? Number one, I would say it's the textbook example of a portfolio of like, if you're young, you shouldn't chase dividends, just go for growth. You look at his holdings ranging from Broadcom all the way down to Duolingo, Costco, Meta. They're not exactly the poster child for dividend stocks. Rather, every single one of his holdings are fueled for growth. I mean, the portfolio name is Moonshot. You're either gonna go big or go home. So I think Adam's risk profile and tolerance is a lot higher than mine. But instead of going into really speculative companies that are not turning a profit and are free cash flow negative, he has all of the heavy hitters that are actually decent. They have good financials, fundamentals, and metrics. I mean, one could argue they're pretty expensive, because most of their PE ratios, it ranges from like 50 all the way to like a 600 if we're talking about Palantir. He has all of the big growth names: AMD, Microsoft, ASML, and even Amazon. And I know we touched upon it in the beginning, but 6 out of 18 of his holdings are based into those 401k mutual funds or index funds, kind of like the VT Sachs right there, the Vanguard Total Stock Market. You got the Fidelity Select Semiconductors Mutual Fund. You got the Fidelity Target Date Fund for 60. And to be honest with you, it makes a lot of sense. You sacrifice a tiny portion of your paycheck in order to get your employer's matching contribution. And I always say this to everyone, especially if you worked under me in corporate America. I don't know if anyone's ever watched my videos who used to be a part of my team, but I always gave them the same guidance. That is free money. It's not a lot, but it's like you basically increasing your total compensation by like 3 or even 5%. If your employer does not give you a matching contribution for your 401k or tax advantage account, dude, they're being petty. Because the whole idea is this: if you put in 3% of your paycheck, your employer is also going to put in 3%. So it's effectively getting a 3% raise for every paycheck. Does that make sense? Now, at this point in the video, let's go ahead and give Adam's portfolio a grading and evaluation based on 4 different criteria metrics. The first one is going to be the asset and strategy fit. Do the position and holdings make sense given Adam's goal? I would argue it's an A+, just missing the mark of an S. It's almost entirely in large cap tech companies except for Grab, which is the Southeast Asian version of Uber and DoorDash based on my limited understanding. This portfolio would make someone whose personality is all about stock diversification to have a meltdown, because it's all in into tech. Well, for the individual stock holdings, not exactly for the mutual funds. Actually, some of the mutual funds are dedicated towards the tech and semiconductor space, so I guess they would have a meltdown and be like, what are you doing? But you know what? I'm not going to complain that Adam has so much of his net worth dedicated towards tech, because big tech seems to be what is in favor right now, especially for total return, at least for the past like 5 years or so. That has been the truth. Now, it could change in the next decade or so, but the data is on Adam's side. So even though it's concentration heavy into the tech sector, I bless off on it. Now, maybe the MBA professor who's grading this case study right now, he's probably disagreeing and might fail me, but the numbers don't lie. If you look at the total return for each sector, for the past 1 year, the biggest winner is tech, 49.2% on average. Second place is communication services, which is kind of a weird thing to see, but if you zoom out a bird's point of view and you take a look at the past 5 years, tech total return has been 438%. This is what I mean when I say the numbers don't lie. Now, second place in the past 5 years has been energy. That includes oil and gas. And because of the high interest rate environment, I'm not surprised to see that real estate has been struggling for the past 1 year, but also struggling for the past 5 years. Historically, though, REITs have been some of the best performers in the stock market. Historically. Obviously not for the past 5 years, but as the interest rates are coming back down, I think there's going to be a sector rotation into real estate. That is not financial advice, and I think real estate will be either top 2 or top 3, but I do not know if real estate has what it takes to beat out tech, at least for the next 5 years, as the interest rates come down. But anyways, a 438% return. I feel like a lot of that was probably fueled by the Mag 7 NVIDIA, Palantir. And if we just click right here, we can confirm who are the big ones. And based on the data, that is correct. NVIDIA, 1,200%, Palantir, 1,800%. Is there any others that kind of stand out? Arista Networks. And everybody else seems to still be pretty good, except possibly Intel, Adobe. But we also have MicroStrategy, the Bitcoin proxy company, 2,300% total return. Pretty ridiculous. So even though Adam's portfolio is heavy into tech, I like it. Now, the next criteria is going to be the level of risk, ranging from 1 to 10. 1, super safe. You can sleep soundly at night. You're not really going to have any one of your holdings go belly up. A 10 out of 10 is like, dude, you're gambling. You're pulling on that slot machine. Adam's portfolio, this might be an unpopular opinion, despite me liking that he's really concentrated into the tech space, that does come with inherent risk. This is the definition of a very aggressive portfolio that's going to get the result that Adam wants, which is growth. The downside of growth is no protection on the downside. But, dude, I would argue it does not matter because Adam is 31. I feel like if you're healthy and your lifestyle keeps up with you staying healthy, he has another, 30, 40, 50 years to go. He has time on his side to weather any storm. And besides, historically, whenever there's a recession or economic downturn, on average, it lasts about 11 months, of it going into the red. And then after which point it starts to recover, and you might be breaking even at the 2-year mark after that economic downturn begins. And then after the 3 or 4 year mark, you'll probably see a little green again. However, based on what has happened in the stock market since 2020, whenever there is a huge correction or catastrophic sell-offs, it happens so freaking fast. And then the recovery happens just as fast, like a V recovery. So even if Adam's portfolio feels and experiences turmoil and volatility, I feel like in the worst case scenario, based on the past 5 years, 2 to 3 months of pain, and then you'll be okay, right? And besides, historically, this is not a universal truth, but every single time that we have had a downturn or a correction, the stocks that are in his portfolio, except the newer ones, they have recovered and rebounded to new all-time highs. So the evidence and the data and how the stock market is behaving ever since investing has become more accessible to the common person, I feel like the patterns that we have seen in the past of how long it takes to recover, it has kind of changed because whenever the big money jumps out of the market, it seems like retail investors like you and I, the amateurs, we pile our money in. And so that affects the markets and has a bigger impact than we would give credit for. Because in the past, I would argue institutional investors, big banks, and hedge funds and super investors probably made up the bulk of the stock market, right? Now it's probably 50-50. Because we know if you want to build wealth and get rich eventually to live off dividend income, you gotta invest. Whether it's in real estate, whether it's in stocks, whether it's in your family's plot of land back in the home country, you gotta invest in something, right? Something that can generate passive income. And that's why I feel like the broader market, we see faster recoveries than usual, especially when you compare it to the 1940s, 1980s, and even the 2008, 2009 Great Recession. So as long as one does not panic sell, like what we saw back in April, when the entire stock market went down 20, 30, 40%, as long as you don't panic sell, you'll be okay. Because it rebounded just like it did time and time again in 2024, 2023, 2022, 2021, and so forth. But having said that, just in case you're only listening to the video and not looking at the visuals, for his level of risk, I would say it's a 5 out of 10. It is kind of risky, but also kind of safe at the same time because he has such high quality names comprising the bulk of his portfolio. Meaning, historically, even if they do go on a sell-off, they have rebounded. Now, when we talk about the quality of holdings, do they have an economic moat? Are the fundamentals sound? Are they compounders? Bottom line up front, I would say, based on my name, Amos, an A-. Now, don't get me wrong. I like the individual picks for the most part. I think it's a healthy representation of the Mag 7. Hurts my heart to not see Apple represented, but it's okay. My favorites out of Adam's portfolio would include Google, Microsoft, Palantir, and AMD. I really like those. A close silver medal would be Broadcom. And Costco, as much as I love their business, I truly do think for a retailer that's selling groceries and knockoff Lululemon pants, I do think they're very expensive as a stock investment. But as an operation and on paper and as a business, I really like Costco. So I would give them a bronze medal. I just feel like their valuation makes 0 sense. It's too expensive, but it's still a really good company. Now, the grade would be higher, but Adam does have stocks in the portfolio that I just do not like at all. And that's Duolingo and Grab. Now, talking about Grab first, I just don't know enough about Grab. If I do my research and due diligence and I analyze the company and I find out they're amazing, I could change my opinion. Now for Duolingo, I did look into, and I do not like their future and their economic moat. I don't think they have one. And I think too much of their trading multiple is priced in with a narrative and speculation that they're going to be this big game changer in gamifying the language learning process. I do not buy the hype. Now, I remember one of my assignments, we had to analyze the dot-com bubble crash, and we took a look at a lot of the companies that were just huge, right, with that bubble. There was so much speculation and narrative baked into them, and then when that bubble popped, dude, they went belly up. Now, I'm not saying that Duolingo is going to be that, but when we think about the AI bubble that's happening in 2024, 2025, once this bubble does eventually pop or whatever, I think Duolingo will be one of the handful of companies that will be caught with their pants hanging down below their ankles. Because I think the numbers that they're pulling off right now are predicated upon all of these flash deals and sales that they're always just throwing in front of your face whenever you open up the app. And that's coming from a guy that used to have a 700-day streak with Duolingo. And then eventually, I just stopped using the app altogether because I found out that Google Translate is so much more effective for me to learn a language, but also to communicate and convey what I want to say. Like, I live in Japan, and I try to learn the language through Duolingo, and you basically only learn, like in Spanish terms, hola, ¿cómo estás? Like, you barely learn, right? But they make it so fun and gamified that you feel like you're learning. But if you're mature enough and your brain is developed, you wake up one day and you realize, like, dude, I'm not actually learning anything. But once you start communicating with people through a translation app that uses AI to transcribe what you want to say in real time, that's the fastest way to learn a language. Or if you don't even want to learn a language, you can get by with just Google Translate or even Apple Translate. I don't buy into the Duolingo hype. But I will say this, bouncing back to Grab. If Grab is anything like Coupang over in South Korea, then I would argue Grab has a bright future. Because initially, Coupang began their endeavors in South Korea as just like an e-commerce company that could promise you a rocket delivery in 12 hours or less. But now they're copying the Amazon playbook line by line. There's Coupang Play, which is like their streaming service. They offer a cloud service. They're doing everything that Amazon does. And what I'm saying is Coupang is changing the name of the game. At least it is over in the Korean peninsula. So if Grab is doing the exact same thing in Malaysia, Philippines, Singapore, then I would feel bullish as well, but I did not look into that company. Now, moving on to the topic of opportunities for improvement. What would I do differently if I had to improve this portfolio as an MBA case study assignment? Like my grade is contingent upon making modifications. Well, I think before we get to that point, I want to vomit my own personal investing style here for a little bit. I think number one, as I assessed Adam's portfolio, I mean, obviously it depends on the individual, right? It's called personal finance for a reason. It's personal. It depends on your preferences and your viewpoint and your goals and your outlook and your risk tolerance. But for me, taking a look at Adam's portfolio, I really do think it's a little too heavy into the tech space. He has all of his bases covered within tech, like semiconductors, AI, software, social media, etc. The fact that every single one of his individual stocks are located into tech, except, I guess one could argue, Costco, it just, you know what I mean? You ever heard of that phrase, putting all of your eggs in one basket? I mean, what happens if the handle snaps off that basket, right? All of your eggs smash all over the floor. You're counting your macros because you're a bodybuilder and you start scooping up the egg yolks and you bake a scrambled egg with it. But you see what I'm saying? That's why I think it would be healthy to introduce just two sectors into this portfolio to optimize it, to make it into like that S tier caliber, at least for me. Number one, I would introduce at least one or two finance or fintech. Number two, possibly a fast-growing restaurant chain. Although I'm going to pump the brakes because one could argue Adam does have coverage in fintech because of Google and Google Play, but I'm talking about a dedicated finance player. And some people might even pump the brakes and slap me in the face right now and say, hey, if you're going to slap me in the face, you got to buy me dinner first. But some people would even argue that he needs biotech or a small pharmaceutical startup, a research lab, or a very speculative rare earth metals type of company like that will deliver better results. But whenever you think about those categories that I just mentioned, it's a hit or miss. It's either boom or it's going 99% into the red. And I hate to say it, but if you go into biotech or startup pharmaceutical companies trying to find a cure. Like, I love what they're doing and I hope they are successful in their mission. But as an investment, I hate to say it, but it's borderline gambling. Because when you think about the clinical trials and the patents and the drug or medicine going to market, there's so many freaking hurdles. For every pharmaceutical or biotech company that is successful, like for every one, there's 99 that will fail and go bankrupt. It's just the nature of the beast. Likewise, when we think about these speculative businesses, for every shining star, there's going to be 99 stinky, hairy, ugly businesses. And as a guy that used to be a strategy leader in the biggest pharmaceutical company in the world, I, for one, understand how freaking difficult it is to predict who's going to come up with the next big drug or cure. Because even us, with the biggest and the brightest scientists and researchers, even our clinical trials were failing left and right in our drug pipeline. So when you think about these smaller startups, dude, it's just a very complex situation. So I really like how they're trying to cure the next disease or virus or illness. I really love that. But as a potential investment, for me, I stay away from my former industry. So I wouldn't recommend going into that section of the pool. It's like when you jump into a pool, you know how they have like a kiddie section that's like only like 2 feet deep? Dude, it's like just full of urine. It's not good. Just stay away from the speculative crap. And I think for the most part, Adam's doing a very good job because I would argue most of his portfolio is in technically sound, tech-oriented companies, except possibly Grab and Duolingo. And before you burn me alive at the stake of why I even suggested a fast-growing restaurant chain, let's just take a look at the data, okay? And the best part is they're all pretty much beaten up right now. There's a sector rotation happening where big money is jumping out of restaurants right now. So one could argue it's a good buying opportunity, and on the other side of the argument, it's a falling knife. So the first one I want to show you is Chipotle. What we're taking a look at right now is their adjusted stock price total return. If we zoom out 10 years, take a look at this, 191%. So you would have 2x your money into Chipotle in 10 years, not that bright. But if we do 15 years, then we're talking about 1,000%. And if we do 20 years, 4,546%. Friends and family, they're in the business of selling burritos and tacos. Another one I'll give you is Wingstop. Now, I'm allergic to chicken meat. I've never been inside of a Wingstop, but that doesn't take away from the fact that Wingstop is just killing the game. And apparently they're much better than Buffalo Wild Wings, otherwise known as B-dubs. 1 year out, obviously they're down in the red like almost every other restaurant. But if we zoom out like 10 years, 1,196%. They're in the business of selling chicken wings with different sauces like honey mustard, ranch, teriyaki, you name it. If we do the entirety of their stock market history, I guess it only goes back to 10 years, but 1,196%. I'll give you another one. Let's see. Shake Shack. This is one that's on my watch list for a while. They're in the business of selling premium burgers. Whenever I go to a shopping mall in the US and I look at the food court, Shake Shack and Chipotle always have the longest lines. Me personally, I like that Ma and Pa Chinese takeout, like Sarku Japan, Panda Express. I like that, but I guess the masses would disagree with me. Obviously, 1 year, they're in the red. But if we zoom out to the entirety of their stock market history, actually, this is not that impressive. You would have only 2x your money in approximately 10 years. Okay, we could get better than that. Okay, maybe this one will be better. Texas Roadhouse. This is a company that I am invested into, but I think their growth story has been slowing down as of late, and the sentiment is changing around the company. I still think they're pound for pound much better than Cracker Barrel. If we zoom out 5 years, we're talking about 172%. 10 years, we're talking about 400%. If we do 15 years, 1,400%. So this is a much better example than Shake Shack. All that to say, it's not just tech that sees explosive growth. If you take the brightest gem in any sector in the stock market, including real estate, you'll see total returns just like that with the fast-growing restaurant chains. You can find beauty and dividend compounders in any sector, and I'll stand by that. It just so happens that in the tech space, there's a lot more compounders in terms of a percentage and statistically, whereas with the restaurant space, there's a lot of ugly companies, but the shining stars are pretty darn shiny. And as for the fintech, I thought about this for a while, and I think the one that would make the most sense, like who's going to be the biggest disruptor in the financial space? It's really difficult and hard to say, right? I'm kind of leaning towards cryptocurrency, but that whole industry as a whole is really speculative, right? And so I think a slightly safer alternative, actually a much safer alternative, is going to be NASDAQ. Ticker symbol NDAQ. They operate the NASDAQ stock exchange where a lot of our beloved blue chip companies are publicly listed, but they also do cyber defense for financial firms, like making sure there's no fraud happening, and they do so much more than that. And they're also responsible for the QQQ, the NASDAQ 100. The best 100 stocks on the NASDAQ. And I said it before and I'll say it again, I think NASDAQ is the much better cousin and alternative to the S&P Global, ticker symbol SPGI. Their leadership team is much better, their future looks better, and I believe in the trajectory of their company's future, way more than SPGI. If we take a look at their stock market history of 1,600%, this is absolutely the definition of a compounder. You jump on over to the cash flow statement and you consider their free cash flow, like what's the cash profits left over after funding for the operations. This is a beautiful picture, right? In 2015, we're cooking with $594 million. But the fact that they were able to increase it to $2 billion in a span of 10 years, dude, percentage-wise, that is absolutely crazy. So NASDAQ, I think, is a pretty good contender to kind of round it out. And another fintech company that I'm probably going to do a dedicated video and a deep dive for is Toast. Ticker symbol TOST. It is a cloud-based platform that helps restaurants to process orders, to manage inventory, to calculate their employees' payrolls, and to enable payment transactions. A one-stop shop for all the various restaurants that are operating in the US. One could argue they're best in class in their industry. I do think they have some competition from Block and Fiserv's Clover. But I think Toast probably has the biggest market share. And if we take a look at their numbers, it's just as juicy as a Mag 7 company. For 5 seconds, just bask in their financial performance. We're looking at their top line right now. Just look at the growth rate of it. 100%, 60%, 41% year over year. Take a look at their cash flow. I mean, it's a software company, so they're going to be flush in cash, right? They don't have a lot of overhead costs of paying for various warehouses or production lines. They're running software engineers. Yes, $500 million of free cash flow. This one I like because it's kind of like two birds with one stone. You kind of have exposure to the restaurant space, but also finance. Now, I'm not personally invested into Toast, but it's on my watch list for a pretty good darn reason. Now, one could argue their trading multiple very expensive. I would agree, a 99, but I just want to call this out, okay? If we think about Palantir, their trading multiple is just shy of 600. So don't you dare spit in my face and say Toast is trading for too high of a trading multiple. And then some other call outs from me. When you take a look at Adam's portfolio, it's about $430,000 at the time of making this video. Take a look at his top holding, Broadcom. Right? $136,000. That means about a third of his portfolio is from Broadcom. And of course, there's a train of thought to let the winners keep riding higher. Me personally, now I'm not trying to tell you what to do. Me personally, I would capture some of the profits and reallocate it towards the ones that are lagging, like just by an eyeball test of your portfolio. A holding that's not performing to that of their peers would be Amazon, right? And they're only up by 7% while everyone else is at least 20, 23%, 34%. I'm sure as of right now, your AMD holding is probably a lot higher because they just went to the moon. I think now they're $200 a share. I kind of regret selling out of them, but hey, I bought into them at like 85 bucks, sold them at 145. I'm still a happy camper, but I want to articulate my thoughts on why I'm saying Amazon might be the opportunity here. I'm not invested into Amazon, by the way. If you ever think I'm just trying to pump my own stocks, shame on you, because I'm not that kind of guy. I just like talking about stocks, and I'll give you an objective opinion. Like, Amazon is a solid, high quality company. I'm not invested into them, but it doesn't mean that I have to hate them, because where I'm from, here in Japan, real recognizes real. If I see something that is beautiful, I'm gonna say it as it is. It's beautiful. Now, why would I allocate some of the big profits into Amazon? Because historically, whatever Mag 7 has underperformed against their peers will eventually outperform, such as Meta in 2022, such as Google leading up to 2025, and Microsoft as of late. I remember reading the various articles talking about how Microsoft sucks, because for the past like 1 year, they were only up by like 7%, but now they're up to the moon and now they're outperforming. So when you take a look at the Mag 7 for the past 5 years, I think everyone is doing pretty well, in particular NVIDIA. The only one that's not doing so hot is Amazon. You're telling me in the past 5 years, Amazon is only up by 40%? I'm gonna tell you right now, that's kind of unacceptable. Actually, 38%. So what I'm saying is, Amazon right now is lagging, just like how Meta, just like how Tesla, just like how Google, Microsoft, they also lagged at a certain point, but then eventually they become the kings of that particular year. I don't know when Amazon's gonna be the overperformer. Is it gonna be in 2026? I don't know. Is it gonna be in 2027? I don't know. But based on the data, whoever underperforms will eventually be the top dog and winner. But remember, you can't really dictate the future predicated upon the past. That's why people like to scream past performance is not indicative of future gains. Just because Google rallied up to the moon, just because Microsoft rallied up, let me just pull them up and show you what I'm talking about. So Microsoft, for the longest time, from the end of 2023, when they were about $376 a share, up until like this year, when they were also like $370 a share, there wasn't that much growth, right? People dismissed Microsoft and they were like, dude, I'm gonna sell this company. This company sucks. For me, I doubled down and I put more and more of my money into it because I knew that Microsoft was undervalued. And then what happened to Microsoft? Eventually, they rallied up to the moon. They're now, what, 528. You jump on over to their financials. This is quite literally the definition of a dividend compounder with cheese. They have their bases covered in every single metric and fundamental. Now, I really wish I could say the same about Amazon, because when we jump on over to their financials, it's just as pretty, right? Their revenue is really, really beautiful. You take a look at their bottom line per share. I mean, I think 2022 was a fluke year, but it's also just as juicy. Jump on over to the cash flow. Amazon is a company that has been associated with stock-based compensation. I think it's a poster child, and you already know how I feel. I love stock-based compensation. Oh, but it dilutes the shareholders. It takes away from free cash flow. It doesn't matter, friends and family, because when you align the interests of the shareholders with that of the employees, in that they win if we win, if the share price goes up, I love it. You take a look at their free cash flow, and I would argue this is probably their only blemish. It's down 72% year over year, and that's because they're spending a crap ton of CapEx right now to expand AWS and their AI endeavors. And this is the other one that I don't really like. Amazon does not pay a dividend, but if I'm a betting man, I can't tell the future, but who thought that Google was also going to pay a dividend, right? Google now pays a dividend. So I'm guessing, I think Amazon's at that point where, dude, you got to return value back to the shareholders in other ways. You can definitely afford a dividend. But anyways, all that to say, Amazon's on my radar and I might pull the trigger here in a bit. I haven't yet, but I'm monitoring their technical analysis to see where the lower Bollinger Band is. That way I can kind of buy them near the bottom. But jumping on back over to Adam's portfolio, I think there's many different profit-taking strategies out here, right? Some people sell with no rhyme or rhythm. They're just like, oh, I'm in the green, they sell. Other people sell at a target price, like for instance, Broadcom. They're trading for 327. My price target for them is 325. Now that I know they hit my price target and they're above it, then I'll sell them. Other people, they sell after, I don't know, say you're up in the green right now by 126%. They'll sell after they're in the green by 150% or whatever. There's so many different strategies. But if this was me, I'm not trying to tell you what to do or anyone else what to do. I'm just telling you what I would do if this was my portfolio and I had to answer the classroom instructor because I raised my hand because I'm an idiot. Then this is what I would do. Let's just say hypothetically, I invested $50,000 into company X. And let's say that it climbs up to $150,000. I got really lucky. I 3x'd my money. Then I would sell my cost basis, meaning I would sell $50,000 of the profits so that everything else invested into company X is just playing with free house money. Now, if it climbs higher, it's climbing on pure profit. So in this example, the $100,000 that's left over invested into company X can go higher or lower. It doesn't matter. The original 50 grand that I invested into company X is safe and sound, and it's been returned back into my account. You see what I'm saying? Now I can redeploy that into something that's undervalued. Off the surface level, for me, I would go with Amazon. I'm not telling you what to do. It's just probably what I would do. And another thing that I want to mention is I would also say to continue maxing out your Roth IRA, your 401k accounts, whatever, your TSPs, while you still have this active income that seems to be pretty high, right? As it's pouring in, keep investing. And that's not financial advice. That's just setting yourself up for the future. Because when you're invested into your 401k with a matching contribution from your employer, you're basically getting a pay raise and it's going into VTI or VU or something like the S&P 500. You kind of have your safety net, right, of like a 10 or 11% ROI year over year. That way, if you know you're going balls deep into like Grab or Duolingo, at least in the back of your mind, psychologically, you know you still have a safety nest. But since you rolled all of your retirement accounts from the past employers into one, you'll notice that some of your funds, they do have overlap, right? And some of them will probably have a higher maintenance fee. So I would go with the one that has the lower expense ratio fund and sell the one that has the higher expense ratio because it's the exact same thing, but you're just paying a higher maintenance fee to keep that mutual fund or ETF. It's just what I would do personally. And other than that, on a final note, I'll say this, Adam. I like your portfolio, given your goal and your age. I'm not exactly in love with the Duolingo holding, but hey, I'm an idiot. So what do I know? Maybe Duolingo will be the next Mag 7. Maybe everybody and your grandma and your wife's boyfriend, everybody will be using Duolingo in the future, and I'm wrong. But other than that, as a general rule of nipple, I think Adam's portfolio, it's proof in the pudding. 2 stocks are essentially responsible for a majority of the gains. Everybody else, it's kind of modest. ASML, 30%, Netflix, 29%, Microsoft, 31%. But when you take a look at Broadcom, 126%. He 2x his money in that. And when you take a look at Palantir, 947%. Everything else is modest, but those are the 2 winners that are carrying the entire team on his back. I kept saying it on this channel, even before Cam Scatabo was drafted. I said he was going to be pound for pound the best running back in his draft class. They are basically the Cam Scatabo of the New York Giants. I don't even support the Giants, but I know they got a winner in Cam Scatabo. That's why, even in your own portfolio, if you just have 1 or 2 winners that really win, like Broadcom or Palantir, you'd be a happy man. That's why, as a guy that used to do diversification and buy stocks from every single sector and industry to diversify away my risk, dude, I stopped. Because once I learned this, you don't need to hit a home run with every pitch. If you just hit a home run with 1 or 2 stocks, dude, you're good to go. You don't need to spread yourself thin across the board on low-level convictions. If you only put your money into high-level convictions that you truly believe in, like Adam did, if you concentrate your capital into the strong conviction businesses, that's pretty much all it takes. Now, the hard part is, what if your strong conviction, high-quality business is actually ugly and you're just biased because you're emotionally in love with it and it goes down in the red by like, I don't know, 50% red, negative 80%. Then, of course, it's terrible. And that's why the stock market, it takes a little bit of luck. right? You can calculate a forecast, you can digest the numbers all you want, but at the end of the day, it's really hard to predict who's going to be the next Palantir. But anyways, give me some feedback. How do you think I did in analyzing and evaluating Adam's portfolio as an MBA case study assignment? Do you like Adam's strategy? Do you love his portfolio? Do you hate it? Give us feedback, please. And before I get out of here, if you want your portfolio roasted, dude, you can go ahead. You can submit it through the Google Forms link in the pinned comment or video description. Now, with that said, I love you guys. Stay safe. Good luck in the stock market, and I'll talk to you next time.